Hello, everyone, and thank you very much for taking the time to join us this afternoon. My name is Carl, and it's my great privilege to be the host for the session. A couple of thousand people that have registered, and that is no surprise because the title of today's session for our Easy Equities community is What the Smart Investors Are Watching in 2026. Another way, perhaps, to interpret that is how to make money, which is an answer we all want. Now, sadly, markets don't hand out easy answers. And 2026 is already throwing us lots of mixed signals. I can't believe it's only February. Inflation behaving differently across the world, political uncertainty always, and sectors are rotating faster than many of us would have predicted. And the job of an investor, retail, institutional, is not to predict the future, but to read clues and to make disciplined, informed decisions. And so at Easy Equities, we sit in a slightly unusual but very deliberate position. We operate at scale in the retail environment, but we also house serious institutional investment capability. And across our platform, we're approaching that 100 billion assets on the platform. And that matters because the same thinking, governance, and rigor that applies to institutional portfolios is available to everyday investors, you and me. So today's session is about giving you visibility into how professional investors are thinking right now. And I'm delighted to be joined by Duane Gilbert, who is our Chief Investment Officer at EasyRetire. And Duane is not only super smart, brain-wise, as an actuary and as an analyst and an investment officer, but he always dresses smartly, which means I don't need to. And so what Duane and his team, Vikash Katlejo and the broader investment team do is really to look at the market cycles, to look at history, to look at current affairs, valuations, behavior, and then to make well-informed, disciplined decisions about where risk can be awarded by picking amazing managers. So Duane and his team are multi-managers. So this is not a debate of passive versus active. We think there's a place for both. But the real question is where each approach works best, when it works, and how to combine them intelligently. And so without any further ado, Duane, thank you very much for joining us. How are you doing?
I'm doing very well, Carl. Thank you for having me on your podcast, and thank you for everybody who's attending. It's quite a staggering number of participants, and I hope that I can provide you with some useful information.
I have no doubt that you will. This is easier than raising a newborn kid, which you are doing brilliantly. So this is much easier. But Wayne, let's start. When looking at markets right now, inflation trends, geopolitics, what are some of the real signals that we should be watching out for? And maybe to throw you in the deep end from the word go, talk to us about currency and exchange rates and what's happening in that world.
All right, I'll kind of speak broadly to our framework on how we approach the big problem of how to allocate assets and where the risks lie. So the starting point, whether you like it or not, is always the US market. And I know a lot of people don't like to hear that, but the US is still the center of the world, regardless of whether you're sitting in the US or Europe or any emerging market. What's happening with US markets, what's happening with the dollar, and what's happening with the US Fed, and coupled with that, inflation. Some of the big themes that you need to start with. So, just speaking broadly about US markets, so we have been in a bull market since the COVID crisis. Markets have gone up almost in a straight line with a bit of a hiccup last year because of the tariffs, but markets recovered from that quite quickly. They've been quite resilient. And broadly speaking, the US came out of the COVID crisis with the most amount of stimulus, the most effective stimulus, the earliest stimulus. A lot of that is still finding its way into asset prices. We've had the tech boom, and the discovery of artificial intelligence, and that's been carrying markets. And we've had broadly good employment and productivity growth. A lot of the productivity growth on the back of AI, by the way. So the US market's largely intact, and the So that kind of creates an underpin in terms of having that global growth and that's supportive to equity markets such as South Africa, and supportive of investors venturing out of the US into other economies and emerging markets. So the second thing we like to speak about is the dollar, and then this will directly answer your question about the exchange rate. So the dollar's been under a lot of pressure last year, and that's been a story that's been in the making for a long time now. What we're seeing is that a lot of countries that are not closely aligned with the US, such as China, such as Russia, are rotating out of the dollar into gold. And this really started when Russia invaded Ukraine, and the US confiscated Russian assets and introduced some very strict sanctions on Russia. And that's when you saw central banks rotating out of their US bond holdings, which, by the way, is why US bond yields are so high, and rotating out of their dollar holdings into gold. So that's helped the rand in two ways. Firstly, the rand dollar exchange rate. There's two components to the equation. So if the dollar is weakening, that automatically helps us. But secondly, we have a lot of gold miners in our country, and we're responsible for a lot of the new supply of gold in the world. And so that demand for gold, and I guess the second effect has been the demand for industrial commodities from this AI boom, for chips, for batteries. All of those things have helped commodity demand. And at the end of the day, the rand is a commodity currency. And so in the backdrop of what I said at the beginning, with good global growth, and in the backdrop of this commodity cycle, which is driven by something quite unique. In previous cycles, it's been more a story about China, but this has been a very unique story. And so we've seen a very strong rally in the rand. And usually as portfolio managers and asset allocators, when the rand breaks 1650, we rush to the door to try and externalize assets. But it's something I'd warn against, because yes, I think the dollar and the rand may have overshot a bit, and the gold price definitely overshot. But those trends are still firmly intact, and we always speak about fair value of the rand. If you remove, you look at the purchasing power parity, that actually sits closer to 13 rand. So it's I'm not saying don't take money offshore, and I'm not saying that the rand will definitely strengthen, but there's definitely enough forces to keep the rand strong, at the very least.
Awesome. So, Duane, maybe just talking a little bit more about currency. I mean, some of the less traditional questions or opinions. There's a new stable coin that's now available in the market, Zaru, which EasyEquities, Sanlam, Luna, and a bunch of other amazing institutions are involved in, which pegs a digital currency to the rand. Do you think people like you and your team are going to look more in future, not just at the traditional currencies, whether that's dollar or commodities like gold, but start considering the impact of digital currencies, or aren't we there yet?
I think, unfortunately for institutional investors, the regulation explicitly prevents us from investing in digital currencies. But I think, for retail investors, digital currencies are effectively another form of hard currency, like gold, like silver, like copper. And these things, I believe, are going to play an increasingly important role in portfolio construction. I've mentioned it a little bit earlier, but since 2008, since the 2008 global financial crisis, the supply of dollars and the amount of US dollar debt has just been going up in a straight line, and in fact exponentially at some points. And that undermines the currency system, because we are basically based on, the world runs on the dollar as the reserve currency, with the expectation that the dollar supply is stable, and the US has effectively brokered that contract. So you're seeing a lot of countries. I mean, I spoke about Russia and China, but you also see the oil countries as well, all moving away from money that can be printed, money controlled by the central banks, into things that have a more stable supply. And so, yeah, I think, look, I'm not a digital currency analyst, but I do believe that they will play a bigger role in portfolio construction for retail investors.
Cool. So we spoke a little bit about dollar, a little bit about rand, a little bit about digital currency. Maybe to end, before we go into the next part, as you give us thoughts where to place our money, you rightfully pointed out, whether some of us like it or not, dollar is where we start. But with the moves that particularly China's making to have their currency as a world reserve currency and stuff, do you think that is always going to be the case? So, serious question. Would you think that the US are taking it for granted that the dollar is going to be this worldwide store of wealth for many? I mean, we had talks about the Danish selling out of their pension funds.
Yeah, no, absolutely. I think it's not something that will play out over 1 year, but I think over our lifetime, the trend is clear. I mean, you look at BRICS and the formation of BRICS and the additional countries that joined BRICS, not last year, the year before, including a lot of the oil nations. And from a commodity, a hard commodity point of view, those countries produce, I think it's almost 70% of, or they own 70% of the world's commodities. And that's besides probably more 80, 90% of the world's population. But that is the first step in moving away from the dollar currency, because the US, post World War II and with the Bretton Woods system, they deliberately placed themselves in a very strong position where if you had to trade globally, you had to use the dollar, which meant that anybody, the dollar is the only currency that's an asset. For any other currency, it's a means to an end. If you want to buy gold in South Africa, you buy the rand in order to buy the gold. You don't buy the rand as an investment. You buy the rand to buy the gold. The dollar is the only currency that is an asset class. And so you have to sell whatever your country produces to buy dollars, which can just be printed. And they've gotten away with it for a long time, but I think the tides will turn.
Excellent. It was like a description about it being the only currency that's an asset. So just before we carry on, next question, the session is being recorded, will be available on our social media and YouTube. And it's just great to see people joining from Russia, from the UK, from Australia, and then all across South Africa. Senekal in the Free State, Brakpan, Pretoria, Plate, Rustenburg, all of these guys giving us a shout out. So it's really great how big this Easy Equities community is. So Duane, next question, let's park exchange rate and currency a little bit and talk about something that you've written about often in the past, which is that over a single year, perhaps sector exposure often drives an outcome more than individual stock selection. And perhaps you can talk about what we saw in 2025. You briefly touched on it with gold miners, the recent commodity surge, and how you and your team think about sector exposure versus individual stock selection.
Yeah. So I believe that your asset allocation decision and your sector allocation decisions really determine 80 to 90% of the risk in your portfolio and the returns in your portfolio. If you had missed out on gold miners, if you had missed out on AI, stock selection wouldn't have done much to bridge the gap. Now, that's not to say that we should be swinging for the fences. I think in terms of our sector allocations, it's not to say that today we in banking, tomorrow we're in resources, but it means we have to have a sensible asset allocation and sector allocation for how we view the world, and it has to be robust, because we don't have a crystal ball. We don't know exactly how things are going to play out, and we need to be positioned for a variety of outcomes. So, like I said, I believe, that we are still in the bull market, and so it's a good time to be have a strong exposure to equities in your portfolio. You might want to consider reducing your cash holdings and your bond holdings. I believe that we've shifted a lot of our some of our global exposure into South Africa. We get it having a lot of tailwinds because of the commodity boom. Um, it's a virtuous cycle where the commodity companies, the miners, they big revenue generators, so that in turn, they're big revenue generators for SARS, which helps the government, helps improve the debt trajectory, and they support a lot of sectors on the side as well as attract foreign investors. So we have a good exposure to SA equities, good exposure to the small and mid cap space where there's a lot of undervalued opportunities, good exposure to resources, especially gold. In fact, this week we used the sell-off in gold miners, in the gold price, to add to our gold mining position and our silver position, which is already working well because the recovery is already playing out. And yeah, I mean, I can get into more detail with
No, I
other
think
asset
that's
classes if you
great.
like.
Yeah.
But
No, I think it gives us a great framework. So, and not to ask you to pick individual stocks, but just in that gold and silver, if you wanted to suggest a equity or two for our users to have a look at, what would you encourage them to perhaps explore?
yeah, so I mean, we try to implement our views broadly, not to take too much of single stock risk, because we manage retirement funds and we need to be quite conservative on our positioning. And we don't do the depth of stock analysis that active managers need to do in order to take big positions. So we've implemented through a Resi 15 tracker, very gold heavy, large exposure to gold fields. And I believe that the gold miners are still trading at a discount to the gold price. So and they provide a bit more of a buffer when in times of pullback as well. So we think just having that into the portfolio allows us to play that gold position and get a bit of leveraged upside. Silver is a um, different beast. But the correlation is strong with gold, and the fundamentals I think are very strong for gold, and silver just seems to be piggybacking off of that. But we had a sharper sell-off in silver than gold, which a lot of people don't realize. So just in terms of capturing that recovery, it became the more sensible choice.
Mm. So, as somebody with your team picks managers, so you're, well, as we said, a multi-asset manager, perhaps a controversial statement, but um, after fees, I think one of the stats I read is that 70+% of these active managers actually don't reach their benchmarks or their targets. So simplistically put, they underperform. What are the things that you look at to find those niche ones that do spot the opportunities, that do look ahead and on the right place and the right time, and that we could perhaps emulate as retail investors?
Yeah. I've been doing manager research for 15 years now, and I still have a hard time. So it's a very challenging ask for a retail investor. I think very important is track record. Um, we don't, we always have to qualify that by saying past performance is not an indication of future performance. But the way we also look at it is if a fund manager hasn't demonstrated the track record already, they're less likely to reproduce it. So a demonstrated track record is very important, and I think that's easy enough for an investor to do. You can get a hold of fact sheets. You can look at a comparative benchmark, a comparative ETF, and see how performance is. And where you get the opportunity to, usually as investors, you get the opportunity to listen to podcasts from the portfolio manager. It's good to listen to those. It's good to understand how they see the market, and it's good to see whether what they say today plays out in a year from now. So, if you'd like to have a podcast in a year from now and hold me to what I've said, that's the kind of thing that's important. So,
So let's
seeing that
let
demonstrated understanding.
That's absolutely true, Duane. And so let's talk a little bit about, because we are going to hold you to account because you look after some of my retirement funding. So I watch it closely. You've mentioned goldfields and gold broadly. We've got questions around other commodities like copper and the like. Maybe talk us through some of the other equities that you are holding and your thinking behind that, and at the same time, perhaps a little bit more around bonds. And particularly on the South African bonds, I mean, recently read that there are disputes between the Auditor General and some municipality. Are bonds something that we must run away from, full stop, still explore? So maybe, yeah, just share some of your other exposures and then on bonds to help us in our portfolio construction.
Okay. I actually like talking about bonds. It's just usually people aren't too interested in bonds as opposed to equities. So in terms of our equities, just broadly speaking, globally, we prefer the US as our destination of choice. Um, we can get into the reasons, but I don't want to spend too much time there. I think Europe is facing a lot of structural problems in terms of aging demographics. The fiscus is stretched. The central banks are stretched. They have problems with unfunded liabilities, especially with immigration. So, over the past decade, European equities have significantly underperformed um, US equities. And just anecdotally, you see all the new listings in the US, fund managers moving from Europe to the US. And every tech company is in the US as well. And then the emerging markets, we feel that the opportunity set in South Africa is broad enough to play to capture those trends. So we have a healthy exposure to the US, as I mentioned, and a healthy exposure to SA equities. We rely a lot on our active managers to manage or finesse our sector allocation and manage our stock selection. But like I said, very excited about the mining sector. We spoke about gold, but there are a lot of tailwinds for a lot of the commodities. I've seen a few questions pop up about copper. Copper is actually something we think has a long way to go as well, and something I'm hoping to implement during the course of the year because of the demand for chips and the data storage facilities. And and then the small and mid cap space in South Africa, there's still a lot of good value there. And in a good macro environment, these are the companies that you see unwind their upside potential. So, those are the, broadly speaking. On China, just because I see a question about China. So China is a region I avoid to invest in directly because it's very heavily impacted by regulation. I mean, if you look at, again, going back to COVID, coming out of COVID, China supposedly came out of COVID first. Although you can deny the stats that they released, but they opened up their economy first. Yet, because of government regulations, because they clamped down on the tech sector, the tech billionaires, clamped down on private education, clamped down on the property sector, we saw a tremendous underperformance from China over the last 6 years, and the U.S. equity has almost doubled over this period, and Chinese equities haven't quite recovered they aren't at the level they were pre-COVID. So I stay away from Chinese equities directly, but when there is stimulus in China, when there is growth in China, it comes through in commodity demand, especially when there's a recovery in the property sector and then there's more building. Then that's when you see the demand for commodities come through, and we can play that. Like I said, South African investors are very fortunate, especially I would say easy equities users. You've got the full tool set of everything listed on the JSE, fixed income and equities, and you have the full tool set of everything listed on the US. Bear in mind that you're able to access almost every region from the US and every flavor of depending on how technical you want to get, every flavor of style ETF. There's literally no investment thesis that you can't express with the tool set that we have. And so yeah, just in terms of fixed income. So I'm assuming you're asking about domestic fixed income, South African bonds. So look, South African bonds, like it or not, in any country, the South African or the government is the highest credit worthiness in the country. So, regardless of all the negative news, regardless of the increasing debt, no corporate in the country is able to borrow at better rates than the government. There was a brief period during COVID where that inverted, and I still don't understand that, but corporates were able to borrow at lower rates than the government. But by and large, the way pricing and risk premium works, South African government is the safest entity in the country. The South African bond yields are just too low. You can buy a 10-year bond yield, yielding 8.1%, 8.3%, which so you have to take 10-year duration risk, and usually as duration increases, your risk premium should increase, but you have to take 10-year duration risk just to get an 8% yield. And out of money market income type products, unit trusts, you can secure liquidity and short dated yields of 9 to 10% at the moment. So we've almost got an inverted yield curve. I know our repo rate is a bit lower, but just in terms of what you're able to purchase on the short end of the curve, we have a bit of an inverted yield curve. So I'm struggling to understand, the reason to venture out far into the yield curve at the moment. And again, our dynamics in South Africa are also different from the US. So the US, you have that inverse relationship between bonds and equities. So if there's a wobble in the equity market, your bond position tends to do well. And so particularly when we are fearful of a recession, we like to include bonds. So we don't have any global bonds in the moment. But in South Africa, equities and bonds tend to be quite correlated. So bonds and equities do well at the same time, and they do poorly at the same time. So you don't get that protection. You get more protection from your currency than your bond position. So at these yields, I struggle to look. I even struggle to understand how we got here. I mean, just 2 years ago, you could secure a yield of 12.5% on a 10-year government bond, and now you getting 8%. So yeah, in terms of obviously if you were a hold off the bond, so hold off a bond fund, and you experience that rally from 12% to 8%, it would have been extraordinary. It would have been the best performing asset class. But as a new investor into bonds, I just don't think you're being compensated for the risks.
Thanks, Duane. Talk to us a little bit, spend tons of time. Talk to us a little bit about diversification, how you and your team think about it, and how you think we should think about it as retail investors. So, are you sometimes too conservative? And you mentioned you're looking after people's retirement funding, and so perhaps you're too diversified at times, or yeah, interested in your thoughts around diversification and rebalancing and things like that. Maybe talk to us, how active should we be in looking at our portfolios?
Yeah. Yeah, look, I think especially with multi-managers in South Africa, over diversification is a big problem. And a lot of multi-managers have I've seen some with, I'm going to say up to 16 active managers in the portfolio. And when you over diversify for the sake of diversification, then you end up with basically a benchmark return, but higher fees. And so you end up with a below benchmark return. So I don't believe in over diversification. I believe any manager in the portfolio needs to stand on merit. So uh, regardless of the rest of the portfolio, every fund, every investment, we need to have conviction that it will outperform the benchmark that's placed. But it's nice to have managers that approach things differently, because then you go through cycles of a manager outperforming and a manager underperforming, and it smooths out the return profile. So we like to have managers with different styles, but if we don't, it's good to stay convicted. Um, and then, yeah, just in terms of, I mean, I've spoken a lot about our sector views and our sector allocation, but we like to have exposure to a broad number of sectors and a broad number of classes. And that's largely influenced by a lot of quantitative modeling that we need to do to ensure that we meet our retirement fund targets, which are CPI based. But we manage risk around those targets based on what's really happening in the economy.
Cool. Just before I ask you a wrap-up question, a couple of points for our users. Firstly, again, thank you very much for joining us. There's some fantastic questions and comments, and the marketing team will pick up on those. And the best place to go for answers on Easy Equities is blogs.easyequities.coza. And Isha and the team are doing fantastic work there. So blogs.easyequities.coza is better read than many, and I won't say all, but getting there, financial publications. And so there's a wealth of information from people like Duane, people like Sean Crom, and other top commentators. So check that out. There's lots more information there. And at Easy Equities, we honestly believe that's not one size fits all. If you want to make money overnight, you need to be a gambler or a criminal. Investing takes discipline, takes doing your research, it takes being measured like Duane, not rushing after the next shiny thing without really understanding why you're buying something. But check out blogs, .easyequities.coza. Duane, as a wrap up, I want to ask you and push you a little bit on this. Tell us what to stay away from in 2026. Where, in your opinion, are we going to burn our fingers if we put our money there?
That's a difficult question, and just have to be careful about giving financial advice. But I
Yes,
think,
yeah.
yeah, look, I personally averse to holding South African government bonds at the moment. I don't think you're being compensated for risk. I don't think there's much more upside, and if and I talk about building robust portfolios because you don't get everything right. So if we aren't in a bull market, if there is a wobble, I think that is one asset class that can be hit quite hard. And yeah,
Okay.
if I had to pick one asset class, yeah.
Cool. No, I like that. Yours is strongly agreeing with you and many others. Neelan and I not. Mine might be an emotional decision because I'm
Uh,
invested. But we'll see how it plays out. So we will constantly host these webinars. Check out our socials. There's a wealth of information also on YouTube and elsewhere. And just as a reminder to the thousands of people who registered for this webinar, and others will see it afterwards. But thanks for taking the time to join. We are seeing, 2 odd billion rand new cash on Easy Equities platform continuously. The people on this call in the Easy Equities community are smart. They aren't rash. And so, Duane, I love the fact that you are as measured and considered as you are, because it's probably good role modeling for people like me and some of our other investors before we decide what we do. Don't jump in when gold is high. If I didn't want to buy it beforehand, maybe I shouldn't buy it now. But all of us have the opportunity to build portfolios that are unique to each one of us. And so good luck to you and the team and your asset managers that you pick. And thank you for looking after our retirement funding, billions of it. Good luck to all the retail investors out there. Share your tips on social media with us. You can drop us notes at blogs@easyequities.co.za so that we can see your views and your comments and what you need more of. And we wish you well. And we'll be talking to Duane and his colleagues throughout the year. So thanks very much, Duane, and good luck with your stock picks, your asset manager picks, and raising your perfect, beautiful child, which at the end of the day is way more important.
Thank you. Thank you, Carl.
Keep well,
Thank you, everybody.
everybody. Thank you.